The most sophisticated money on the planet just confirmed, with its own vaults, what the number in the title is telling you. And almost nobody watching the financial channels understands what it means. If you own gold in your retirement account, you are sitting on real gains through this stretch. And the strange part, the part I want to walk you through carefully, is that the people with the best information on Earth are behaving as if the story is closer to its beginning than its end. Here is the concrete fact that anchors everything else I am going to say. A few years back, in 2022, one of the world's major powers woke up to find its national reserves, the savings of an entire country parked in Western accounts, frozen by decree, locked, unusable. And in the years that followed, the central banks of the world did not shrug that off. They went out and bought gold at roughly double the pace they had averaged over the prior decade, year after year after year. Not before the price ran, while it ran, after it ran. So let me pay off the title plainly, right here in the first minute. Yes, gold savers are up substantially. That part is confirmed. And the case that it is still early does not rest on my opinion or anybody's price target. It rests on the observable behavior of the largest, best informed buyers in the world who have kept accumulating after enormous gains. That is not what the end of a story looks like. Stay with me, because near the end, I am going to give you the one test, the simple historical tell that separates a market that is finished from a market that is merely getting started, and how to think about your own position either way. In my years in the gold and silver world, I have learned that the hardest thing for a normal saver to do is hold or add after a big gain. Everything in your gut says take the win, ring the register. And I understand that instinct, because for most of your working life, it served you well. Let me make this human. Picture a retired plumber up in Utica, New York. Call him Frank. 40 years of crawl spaces and frozen supply lines, 40 years of knowing that the difference between a dry basement and a ruined one is usually a $20 valve somebody skipped. Frank has a retirement account he built one job at a time, and when he sees an asset up big, his instinct, the instinct of every honest saver in this country, is that he is late, that the gain already happened, that the smart move is to lock it in or stay away. But here is what I want Frank and you to sit with. The central banks of the world, institutions with entire floors of analysts, with information you and I will never see, looked at gold after it had already made a historic run, and their conclusion was not, we missed it. Their conclusion was, we do not own enough. And they reached that conclusion for a reason you can state in one sentence. A frozen reserve taught them that a reserve held in someone else's system is really just a promise, and a promise can be canceled by the man who made it. A bar of gold in your own vault answers to no one. It cannot be sanctioned, frozen, or voted out of existence. When the freeze happened, every finance ministry on Earth quietly ran the same thought experiment. What if that were us? And their answer is written in the tonnage figures ever since. Now watch what that behavior actually looked like, because the sequence matters. The buying did not fade as the price climbed. It persisted, and in stretches it intensified. More than 1,000 tons a year flowed into official vaults for 3 straight years, a pace without precedent in the modern era. And even as it is cooled from that peak, it remains far above the old normal. Surveys of the world's reserve managers, the actual people who steer this money, show an overwhelming majority expect official gold holdings to keep growing. And along the way, gold quietly passed a milestone that would have been front-page news in a saner world. It overtook the euro to become the second largest reserve asset on the planet. Central banks, as a group, now trust vaulted metal more than they trust the currency of the entire European project. Did anyone at the big networks sit you down and explain that? They did not. Because the institutions that sell you paper products for a living have no interest in advertising that their own regulators and their own central banks are choosing metal. And that is the enemy through line of this whole story. So let me name it once, clearly. The big banks and the financial media make their money on your activity, your churn, your fear, your chasing. A retiree who calmly holds a diversified position in physical metal generates almost nothing for them. So the coverage you get is engineered around headlines that make you jumpy, and the analysis you get treats every rally in gold as a curiosity that is probably over. It has always been this way. Through the entire first decade of this century, gold climbed from the 200s to near $2,000 an ounce, roughly a seven-fold move. And for most of that climb, Wall Street and the mainstream press barely mentioned it. No magazine covers, no specials. A generational bull market ran for a decade in near silence, and the ordinary savers who could have used it most heard about it last. I have watched that movie once already. I am watching the opening reels of it again. Frank remembers that decade too, in his own way. He was still working then, sweating pipe in winter, and he remembers a guy at his union hall who kept talking about gold while the account statements everyone else opened were still bleeding from the tech wreck. Everybody ribbed that guy. The financial shows called metal a relic for people who feared the future. And the relic quietly outperformed almost everything the respectable channels recommended for years before anyone respectable admitted it. The lesson Frank took was not that gold always wins. The lesson was that by the time the television agrees with a trade, the fattest part of it is usually gone. But here is where it gets stranger. And this is the piece I most need you to understand, because it is the actual answer to how can something be up big and still be early. Go back to the great bull market of the 1970s. Gold started that decade around $35 an ounce because the government had pinned it there for a generation. By January of 1980, it traded over 800. But in the middle of that run, in 1976, gold was nearly cut in half. Think about the saver in that moment. He had watched gold multiply several fold from the old fixed price, then collapse for the better part of 2 years. Every instinct said the story was over. The gain had happened, the correction proved it. From that miserable mid-decade low, gold then rose roughly 8 times over. The largest part of the entire decade's move came after the point where it already looked expensive, after the point where it had already crushed the doubters once, after the point where taking profits felt like wisdom. Being up big and being early are not opposites. In the strongest markets of the last 100 years, they describe the same moment. And that is not even the biggest piece, because you can ask a simple, honest question about any mature bull market. Where is the mania? I know what the end of a gold run looks like because it has a signature you cannot miss. In January of 1980, there were lines around the block at coin shops in ordinary American towns. Families dug flatware out of drawers and melted the silverware their grandparents left them. The price gapped higher day after day, and cab drivers gave bullion tips. That is what a top smells like. A whole country suddenly certain, all at once. Now look around you. Is your neighbor talking about gold? Is your barber? Institutional portfolios in this country still hold a historically tiny sliver of metal. For many pension funds and advisors, effectively none. The public is not in this market. The professionals who manage your neighbor's retirement money are not meaningfully in this market. The buyers so far have been the most patient, least emotional actors in the entire financial system. Every mania signature that marks a top is absent. What is present is quiet, official, relentless accumulation. Now, here is a wrinkle inside that story that I find genuinely remarkable, and it points directly at what a saver can still do. Gold has made its big move. Silver, gold's historical partner, has lagged this latest leg badly. The ratio between them, the number of ounces of silver it takes to buy 1 ounce of gold, has stretched far above where it has spent most of history. The men who wrote this country's first coinage law set that relationship near 15 to 1. At the 1980 peak, it compressed to around 17. Through the last century, it has swung wide and snapped back, and every era of true monetary fear has pulled it dramatically tighter, with silver, historically, doing in months what gold did in years once it finally moved. A stretched ratio is not a guarantee of anything, but it is the market telling you that one metal has answered the bell and its partner, so far, has not. And in my experience, that gap is where the patient money looks next. Which brings me to something practical, because understanding all this means nothing if you cannot act on it sensibly. Many retirees I hear from assume that doing anything with gold or silver means selling out of their retirement account, taking the tax hit, and starting over. It does not. There is an established legal structure, the self-directed precious metals IRA, that lets you move a portion of an existing retirement account into physical gold and silver inside the account you already have, without taxes or penalties on the move. To make that plain and simple, our family put together the free Retirement Wealth Protection Guide. It is written for American retirees with $100,000 or more in a retirement account, and it walks through exactly how folks diversify a portion of what they have built into physical metal, including how people are thinking about that stretched gold to silver ratio in a tax-advantaged way. This is not just for insiders or the wealthy. If you have 100,000 or more in any retirement account, a 401k, an IRA, an old plan from a job you left years ago, this is for you. It is completely free, from our family to yours. No obligation, nothing to buy. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. Get the guide, read it at your kitchen table, and then come back, because the second half of this story is the part the headlines have not caught up to yet. Now, let me give you the honest beat, because you deserve the caution before you deserve the case, and anyone who sells you certainty in this business is lying to you. Gold can fall hard, and it can fall fast, without anything fundamental changing. In 2013, nothing more than a hint that the Federal Reserve might slow its bond buying knocked gold down by roughly 28%. A generational bull market nearly halved mid-run in the 70s, as I told you. I cannot tell you the path from here, I cannot tell you the timing, and I will not pretend to know a number. There is also a real headwind worth naming out loud. Long-term interest rates have pushed to levels this country has not seen in a very long while, and high yields on government paper compete with an asset that pays none. Nothing I say in this video is a promised price, a guaranteed outcome, or personal financial advice. It is a case built on history and on the visible behavior of the biggest buyers alive. The reason I remain convicted, despite the headwind, comes down to arithmetic. The last time gold was truly broken, it took a Federal Reserve chairman willing to force brutally high interest rates punishingly above inflation, and hold them there while the economy screamed. The country could afford that medicine then because the national debt was small. It cannot afford it now. The federal debt has grown so vast that the interest alone has swollen past what we spend on the entire national defense. Every meaningful rise in rates now blows a bigger hole in the government's own budget. The one weapon that ever truly killed a gold bull has, by the government's own borrowing, been welded into its sheath. And history says you do not even need a rate decision for the ground to move under a currency. In 1934, the United States government revalued gold from around $21 to $35 overnight by decree, after first ordering citizens to turn in their monetary gold. In 1985, the major governments of the world simply agreed at a hotel meeting to walk the dollar down together, and gold rose substantially in the years that followed without the Fed firing a shot. In 1971, a president closed the gold window with a televised speech and called it temporary. It never reopened. 3 different decades, 3 different mechanisms, one lesson a plumber understands better than most economists. The pressure in the system decides, and when the people in charge need the currency lower, they find a way. The saver holding only paper promises absorbed each of those decisions. The saver holding metal was on the other side of them. Frank thinks about this the way he thought about water. In 40 years of plumbing, he never once trusted a single shutoff. Main valve at the street, valve at the meter, valve under every fixture. Because the day the one you counted on seizes up is the day you learn why redundancy exists. His retirement was plumbed like the houses he worked on. Some in the market, some in cash, and after he read up on it, a portion, not all, never all, in physical gold and silver inside his retirement account. He did not do it to get rich. He did it because he had seen what happens to people who route everything through one pipe and then hit a bad winter. When the metal ran, his neighbors asked if he was going to sell. His answer was the answer of a man who has repaired 1,000 emergencies. You do not rip out the backup system because the weather has been proving you right. Here's the part where I tell you how to think about your own position, and I will keep it to principles, not prescriptions. First, size the metal so that no shakeout can ever force your hand. A portion you can watch fall by a quarter, as it did in 2013, without losing sleep or selling the bottom. The people who get hurt in gold are almost never the holders. They are the overextended, the leveraged, the all-in. Second, understand the difference between metal and a claim on metal. In the panic of March 2020, the paper price of gold in New York tore apart from the price of actual physical bars in London. Planes were chartered, vaults scrambled. Because in a real crisis, far more paper claims exist than deliverable ounces, and everyone tries to stand on the same lifeboat seat at once. Rare moments like that are the market confessing the truth. A promise to deliver gold and gold are not the same thing. The entire lesson of the frozen reserves, the event this whole video is built on, is that the world's most powerful institutions decided they wanted the thing itself, in their own control. A retiree deserves the same standard the central banks demand for themselves. So let me give you the test I promised at the top, the tell that separates a finished market from an early one. At a top, the smart money is quietly leaving, while the public is loudly arriving. Check that against what you can verify with your own eyes. The most informed buyers on Earth are still arriving. They accelerated after the freeze and have never gone back to the old pace. The public has not shown up. No lines at the coin shops, no melted flatware, no bullion tips at the barber shop. The pension funds and the mainstream advisors are still standing on the sidelines, holding almost none. Every seat at this table is still filled by the patient and the informed, and the crowd has not walked through the door. When the crowd does come, and if history is a guide, one morning the coverage will flip all at once. Every network will discover metals simultaneously, and your brother-in-law will call you about it. The comfortable stretch of this story will already be behind us. The window that matters is the quiet one, and the quiet one is the one you are standing in. By the time owning gold feels obvious and safe and socially confirmed, it will have already done the work it was capable of doing. The central banks did not wait to feel comfortable. That is the entire message of their tonnage. And there is one more reason this matters that goes beyond your own statements, and it is the reason I do this at all. What you have built is not just your retirement. It is the launch point for your kids and your grandkids. The difference between a family that inherits options and a family that inherits worry. The decisions you make in a quiet window like this one echo for a generation. That is exactly what the free Retirement Wealth Protection Guide was written for, helping American retirees with $100,000 or more in a retirement account protect and diversify a portion of what they have built and what their children and grandchildren will one day inherit, with physical gold and silver inside the account they already have, without taxes or penalties. From our family to yours, no obligation, nothing to buy. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. And if you have 100,000 or more and you watched this full video, mention that when you reach out. And you will also receive a free one-on-one educational web conference, a real conversation, question by question, about how this actually works for an account like yours. I will not invent a deadline for you, because there is none, but I will tell you the honest truth about timing. The moment when a decision like this is calm, cheap, and fully reversible is precisely the moment when nothing feels urgent, and that is the moment you are in right now. So, yes, confirmed. The gains in the title are real, and the people with the deepest vaults and the best information on the planet looked at those same gains and kept buying, because they learned in 2022 that a promise can be frozen and a bar cannot. Somewhere up in Utica, a retired plumber already understood the principle from a lifetime under other people's houses. You install the backup before the pipe lets go, and you never regret redundancy in a bad winter. The central banks have plumbed their reserves the same way. The only question left is whether you will do for your family savings what they have already done for their nations, while the line at the coin shop is still empty and the quiet window is still open.